have their say.
Yeah, definitely.
Now, this next part that I'm showing here is referring to our dynamic emission rates. And you see, if you look here, uh, if you look at the chart that I'm sharing, oh, wait a second, I have someone calling me.
Yeah, you're right.
Can you hear that?
No.
No.
Okay, fine, I'll ignore it then. So I don't. If I switch screens, then I'm gonna end up doxing my Discord.
Yeah.
So I'll
No
just
worries.
I'll just ignore it and I'll call it back when I get off.
Yeah.
So
No worries.
you see here on the chart on the left, it's emission rate versus price, and what this does is it's showing how the farm contract that is emitting the dog and the pig's token looks at the current demand for the project along with the price of the project to determine the emission rate at which it's releasing dog and pig tokens. Now, we wanted to ensure that it would always be within a range that is one, sustainable and at the high end, and two, still has the still is enough incentive to get people to join the farm at the low end. So what we did is we looked at all the other farms and all the other projects similar to this with an emission rate and looked at what their emission rates were and if they were sustainable for them. And we ended up uh, deciding that a project called Thorium, which really is a very basic farm on BSC, nothing really special about it, has shown to be a sustainable project, or has shown to be sustainable as far as price. And I would say the two things that they have going behind it is they've been fairly good with marketing and they have a great emission rate that is a sustainable emission rate, meaning it inflates at a rate that is sustainable that allows for price appreciation. So what we did was we used Thorium's emission rate as a peg. And if price is at all-time high and the demand is at all-time high, we have our emission rate of our L2 tokens 25% higher than Thorium, which is slightly higher than Thorium, which will be sustainable because we have all of the mechanics Thorium has plus a lot more, right? We have the L1 to L2 migration. We have the governance model. We have the additional tax, the tax on transactions, the additional tax on selling. We have, the way you need to stake the dogs to earn the pigs tokens. We have the BUS reward governance model for the pigs token. All this stuff Thorium doesn't have, right? Yeah. We also have this dynamic emission rate, which is another major thing that Thorium doesn't have. But at 100% emission rate, when we're at all-time high or demand at all-time high, we're at 100% emission rate, which is 25% over Thorium. If our price does a 25% or greater correction from all-time high, between all-time high and all-time low, then the emission rate will adjust to be the same emission rate as Thorium. So this means if our price is just kind of ranging between all-time high and a 50% correction, will be at the same emission rate as Thorium, which is proven to be sustainable without all the other functionality that we added that adds a ton more buy pressure, reduces a ton of the sell pressure, and is removing tokens from circulation in ways that they're not. So reducing to be at their emission rate then allows the current demand that the price is at to now have a positive price impact. So now the price goes back up, we make all-time highs again, and the emission rate goes back to 100% emission rate. And you can see that if you look at the chart on the white paper here that I'm circling, for the first 3 periods, the price is making all-time highs and the emission rate is at 100. The price does a 25% correction. the emission rate reduces by 25%. The price goes back to break all-time highs again, and the emission rate shoots back up to 100%, which is 25% over thorium. It can never go higher than that. We needed to set this range to make sure it's sustainable.
Right.
Now the price does a 50% correction. Now the emission rate will do a now the emission rate will adjust to restrict the supply by 50%. Now, because we have the additional tax on selling, which I showed here, and because the supply is reducing, what this does now is starts removing tokens from circulation at a greater rate than they're being emitted. And now we have a token that allows you to receive rewards in BUSD for staking it without the need for selling it. That's also a deflationary token. And due to those dynamics and the fact that we have that yield in the background that is buying back, and the deposit fees that are going to buying back and removing tokens from circulation, we now have more buy pressure than sell pressure. The demand picks back up. We're a deflationary token, and it allows the price to appreciate. And when the price appreciates, the emission rate will then readjust to adjust accordingly to meet this demand, to now allow the rewards in the farm to be increased as the emission rate increases, to now have additional incentive for those people that are now buying the token, because now due to the lower emission rate and the other mechanics I talked about, that adds more buying pressure, right? That buying pressure allows the emission rate to adjust, increasing the APY of the farms, and now incentivizes those people that newly bought the tokens to add them to the farm. And this removes more tokens from circulation and allows the price to appreciate, allowing the emission rate to appreciate. And the emission rate moves in 25% increments. 25% at a time. It starts out at 100% emission rate. It can reduce down to a 25% emission rate. When it's at a 25% emission rate, this is half the emission rate of thorium. Thorium has proven that at its current emission rate, does have sustainable price appreciation. So at a 50% emission rate of thorium, we should see aggressive price appreciation, which then allows the price, as the price appreciates and the demand goes back up, allows the emission rate to go back up, and now the rewards to go back up, which now incentivizes all those people that are buying the token to sticking them in the farm. And this kind of dynamic ensures that you're not only going to see rewards in the form of APY and in the form of yield from the platform, you're also going to see profits in the form of price appreciation. And we all know from holding drip that the price of a token could be stable, or it could even be depreciating, but it could still be a profitable project because the yield you're generating from it makes up for that. But if it's always best, and I've learned this through experience, that it's always best to get as much of the profit made by investors as possible through price appreciation. And the reason for this is because there's no greater form of marketing promotion than positive price appreciation and all-time highs. When prices make new all-time highs, when we're seeing price appreciation, people are excited, people want to tell people, and it has a viral effect. So we designed this platform to put price appreciation over everything. And we ensure that the rewards that are made on the farm are always high enough to incentivize people to add to the farm, and always always make it so it's always a better ideal for you to stake the tokens in the farm than just to hold them.
Yep.
You're always going to see a greater profit through doing that, but the majority of the profit, or maybe not the majority, but a significant amount of the profit earned is through price appreciation. And I've learned that directly through experience, through creating projects that create a ton of profit for their investors and for their stakers, but a lot of that profit is in the form of yield generated, not price appreciation.
Right.
And I realized if it's possible to design a system through, so you're getting that same profit, but there's a way to kind of shift that profit so it's coming in the form of price appreciation instead of yield. It's better for marketing and promoting. So that's the angle that I took here, and that's what this decentralized dynamic supply control algorithm allows us to do automatically. We're not manually adjusting these rates. It's happening on chain through essentially our contract is just looking at current price data every time someone does a swap, and that's how it's getting its all-time high and all-time low. And all right, so how I came up with this concept is there was a project that had something that was somewhat similar. It didn't have all the other aspects. It didn't have a governance system. It didn't have multiple layers. It didn't have like a dynamic tax on the tokens. It didn't have BUSD rewards. It didn't have any of these things. What it did have was an adjustable emission rate dependent on the price of the token. But the way that they did it was they picked a high and a low price that they just picked as a window from launch. And their high was $100 and their low was $0. And based on where their price was between 0 and 100 would determine their emission rate. What happened was, because this worked out so well for them, the price pumped all the way until it broke $100 and went above their expected window. And when that happens, it threw everything out of whack. So they had to try to relaunch essentially like a Band-Aid contract, which expanded the window. And when they expanded the window, it changed the emission rate, because now they're not in the same ratio between high and low as they were before they changed it. And it, it immediately changed the emission rate by a ton, and it kind of caused a spiral that ended up hurting their project. So what I did was I looked at, all right, this was extremely successful. This was an extremely successful dynamic that, if implemented correctly, does wonders for price appreciation. And speaking specifically to this profit coming in the form of APY versus profit coming in the form of price appreciation, and adjusting the two to ensure that you're always seeing optimal profits, but the profit is coming in what is going to be the most marketable, which is price appreciation, right? So and what I did, and what I determined, what shot out to me the way to handle this, is have the contract determine its own window and have this window be dynamic. and use the all-time high and all-time low as this window. This way,
Yeah.
right from launch, the project immediately starts out with 100% emission rate, and then as it develops and as it as it starts having buyers come in and it starts having its price action, it then sets up its window dynamically so it can never go outside of this window and cause the issues that this other project I was referring to had.
Yeah.
So we see all the benefits that they had without adopting that downside, that overlook that they had. And not only are we doing it in a much better way because we're not putting in that window that limits us, and once it goes outside that window it causes issues. It's also just a better way of doing it because it allows it to be extremely dynamic. So that's what I'm saying when I said that before I launched this project, I looked at what a bunch of other farms and projects like this were doing. I looked at what worked for them, what didn't work for them, what I could incorporate, what I couldn't incorporate, and I took the best aspects of like 5 other projects. I took what worked about them, I improved on that, and then I added them into one project in a way that they all positively compound on each other. So, and I believe doing this is designed to be the highest price appreciating and the most sustainable farm of all time. And just to sum it up in like one or two sentences, why this is, it's because it has the ability to set an emission rate and control the supply depending on the current demand for the project in a way that allows for maximal price appreciation given the current demand, while allowing for maximal APY in the farm given the current demand. And the system allows you to secure profit on the farm, both in L1 and L2, in the form of BUSD, without the need to sell the farm, without needing to sell the farm tokens, allowing you to accumulate a larger ownership position in L2 and a larger ownership of Rev token in L1, which in turn allows you to get into the L2 presale at the best possible exchange rate, at the highest possible allocation size, and get you in there immediately at launch to be a power player and a majority owner right from the launch of L2. And the reason why it's so important to be in L2 immediately at launch is because all farms, no matter what, have a massive wave of TVL at the start, at launch. You're going to see that first big wave. And people who are staking the PIG token in the governance pool are going to get their share of that huge initial TVL wave in the form of BUSD. So for farms, there's a 4% tax. For pools, there's a 6% tax. So essentially, 4 to 6% of all that BUSD that is added to the TVL is being allocated to rewards in the form of BUSD and marketing, with 75% of that being allocated to marketing. So let's say that we get, I don't want to limit us, right? So let's say we get $1 billion TVL, right? Now that is 40 million. 4% of $1 billion is 40 million, I believe. So so it would be 75% of 40 million, which is 30 million, That all right. So I'm just throwing numbers out there because I don't want to say a small number and limit us, right? So I'd rather throw an
for
extra
sure.
big number than a small number, just for people's minds, you know. So, so if we got $1 billion TVL, that is going to be $30 million worth of BUSD that is paid out directly to people in the pig staking pool.
Wow.
So say we say we make 100 million TVL, which is, I mean, that's reasonable. Say,
Yeah.
but say we make 100 million TVL in the first week, say, right? Because the marketers that I'm working with and looking at their past performance in projects that are inferior to ours, they're making 40-50 million TVL in the first day. So say we hit 100 mil TVL in the first week, that's $4 million BUSD paid out in the first week to people in the governance staking pool in BUSD. That's not including the taxes that are paid in the dog token. Now, we know when tokens list, there's always that big rush of capital to come into them. All right.
Spike, yeah.
About 6% of that is also going to the pigs staking pool. That's going to be millions of dollars in transacting volume. Potentially hundreds of millions of dollars. Very likely hundreds of millions of dollars in trading volume of the dogs token. So that's like, very, very reasonable numbers. I could say is $8 to $10 million worth of BUSD paid out in the first week to people that are in the pig staking pool, and a large portion of that will be people that are in there in the first day.
Right.
So, and in the first half an hour specifically, because in that first half an hour before the emissions start, everybody that knows about the farm, from the marketing of the pre-sale and all that stuff, all that initial capital is going to be coming on. So that's millions of dollars paid out. So so I kind of got off track with my couple sentences explanation of why we're going to be more sustainable, but it was just because I wanted to say that this is the only project that allows you to secure profits in BUSD without needing to sell the token. But I wanted to explain just how much BUSD it's going to be. It's not some small amount. It's millions and millions of dollars worth of BUSD paid out in this pool. So So this is it's the only farm that has the ability to adjust its emission rate based on demand, become a deflationary token when demand is lower, allows you to secure profit on the farm without needing to sell the token, allowing you to accumulate a greater position in dogs and pigs. The dogs token is what you use in the core farms to farm the pigs tokens, and the pigs token is what you use to stake in the governance pool to earn those BUSD rewards. So you accumulate dogs tokens to use them to farm the pigs, and the pigs is what you're using to secure profit on the farm. You'll also have a governance model that allows you to vote for proposals in L2. You're also getting a portion of the taxed the tax on dog tokens. The dog token has a mechanic where it's taking a percentage of each trade and is adding that to the liquidity pool, which is deepening and decentralizing the liquidity pool, adding more BUSD to the bid side, and increasing the potential price floor of dogs, especially when you consider when dogs is deflationary, that it is greatly increasing the potential price floor, which means if all the dogs were sold, there would still be a price for dogs at a certain rate. Those BUSDs that liquidity couldn't be removed from the farm. It's essentially being locked in on each transaction. This is by nature the fact that we are incentivizing liquidity adding. The liquidity pools are decentralized and locked. On L2, we have a harvest claiming period, which is adjustable. So essentially, the core farms have a 4 hour harvest period. So essentially, you have to have your you can only harvest every 4 hours essentially, and this is a security measure and also a sustainability measure. It's a security measure because it prevents people from doing flash loan attacks where they could take a flash loan, deposit a very large amount into the farm,
Mhm.
and then claim those rewards instantly and dump them, and then
Yeah.
pay back the flash loan. In this case, there's a waiting period of a few hours, so those kind of flash loan and other exploits
Mhm.
are not possible on our farm. So as far as security goes, we're extremely secure. Uh, we are. Let me just go to L1 here. If I go
Yep.
to the farms,